Hi, Trey. It's Chris from the research team here at Pepperstone. Now, we've seen the Fed meeting coming out. We've seen Jay Powell's press conference as well. We obviously got the 25 basis point cut that was widely expected by the market. But where we have seen a bit of surprise is this two-way descent. Stephen Mirren calling for a 50 basis point cut and Jeffrey Smid at the Kansas City Fed calling for a hold. And maybe that's where we've seen some of the hawkish reaction coming through in markets. We've also seen a little bit of a pushback and this idea and a bit of conjecture about whether we're going to get a December cut. Obviously, if you look at swaps pricing ahead of this situation, we were pricing about an 85% probability the Fed would cut in December. That now stands at 66%. So that's that implied pricing and implied probability of a cut has come down. And also, if you look further out the curve, one year forward rates have priced out about 9 basis points of forward cuts going forward. So, yeah, 1 year forward rates now trading at 307. And also, Powell was probed on this situation. He said it was a far from being a foregone conclusion. They do have some visibility. Ultimately, even when we've got a government shutdown for making a decision in December, they said they can still look at the jobs picture and look at things like the beige book, state level claims, job openings, hard to get within the sub-survey of the consumer confidence numbers. But obviously the government shutdown does make it more problematic. We've seen a lot of focus on the formal end of quantitative tightening, which will start on December 1st, which gives the markets a bit of time to absorb this situation. But of course, when reserves have fallen down to $2.93 trillion and we've seen SOFR rates continuously trade above interest on reserve balances that the Fed pays commercial banks to hold excess reserves on its balance sheet, trading continuously at a premium, it's made the prudent decision to effectively stop balance sheet runoff and reinvest the proceeds from maturing debt into shorter term maturities, which will effectively bring the weighted average maturity of the Fed's balance sheet into line with the stock of outstanding debt in the market as well. But the markets looked at that one very closely as well. Now, if we look at the reaction that we've been seeing in markets to all these factors that we've seen, we have been seeing a bit of lower interest rate expectations for December. We talked about one year forward rate. 2-year treasuries are up 11 basis points. And we've seen the back end of the curve yields moving up, but by a lesser extent. So a bit of a sort of a bear flattening playing through. Now, the US dollar has feasted on that move in yields and lower interest rate expectations, and that's up 0.7% at the moment in terms of the dollar index. We've got a better bid coming through in dollar Swiss. That's probably the performer on the day. S&P futures initially fell about 90 basis points, but they've recovered a little bit in that situation. We've seen selling coming through in interest rate sensitive areas of the market. Gold's under a bit of pressure. We saw it trading up to 4,030, and it's about 2.3% off those highs at the moment. Bit of selling in Bitcoin and swap spreads have come in a touch as well. But certainly that two-way risk, that sort of pushback on December, that sort of focus on what's happening there has seen a bit of a hawkish reaction. We'll see if it can continue. And trade it with Pepperstone.